Disclaimer.
Right now, as you're watching this, two massive forces are racing toward each other like freight trains on the same track. One is carrying our military toward the Persian Gulf in the largest deployment since we invaded Iraq in 2003. The other is carrying 9 Supreme Court justices to their bench this morning at 10 a.m. Eastern, where they'll decide the fate of over $133 billion in tariff revenue our government has collected over the past 100 days. And here's what almost nobody is talking about. These two events push gold and silver in completely opposite directions at the exact same time. Think about that for a second. If you own precious metals right now, or you're thinking about buying, you're standing at a crossroads where the next 72 hours could either validate everything you believe about sound money, or hand you a gut-wrenching dip that shakes out everyone who doesn't understand what's really happening beneath the surface. So let me show you exactly what's unfolding, because the mainstream financial media is covering these stories separately when they should be connecting the dots for you. The Trump administration advisor told Axios this week there's a 90% chance of kinetic military action against Iran. Not sanctions, not diplomacy, kinetic action, the Pentagon's polite term for bombs falling on targets. And when asked about timing, the phrase that keeps coming up is, as early as this weekend. Now, you might be thinking we've heard saber rattling about Iran before, fair point. But this time, the deployment tells a different story than the headlines. Our military has positioned a WC-135R aircraft in the region. Most Americans have never heard of this plane, and that's exactly why it matters. The WC-135R is what insiders call the nuke sniffer. It's specifically designed to detect radioactive particles in the atmosphere after a nuclear event. You don't deploy nuclear detection aircraft for a show of force. You deploy them when you're genuinely preparing for the possibility of striking nuclear facilities and need to assess the aftermath. That's just the beginning of what's moved into position. B-52 nuclear-capable bombers are now stationed at Al Udeid Air Base in Qatar, roughly 400 miles from Iranian territory. The USS Abraham Lincoln Carrier Strike Group is already positioned in the Arabian Sea, and the USS Gerald R. Ford, our newest and most advanced aircraft carrier, left Morocco and is steaming toward the eastern Mediterranean as we speak. Pentagon officials told reporters that the Ford's arrival is considered a key factor in timing. Read between those lines, they're not waiting for some distant diplomatic deadline, they're waiting for assets to reach their positions. But Iran isn't sitting still either, and this is where the situation gets genuinely complicated for anyone trying to predict what happens next. Just this week, Iran partially closed the Strait of Hormuz for what they're calling smart control of Hormuz Strait live-fire exercises, conducted by the IRGC, the Islamic Revolutionary Guard Corps. These aren't routine naval drills. They're sending a message about their ability to choke off the waterway that handles 20% of global oil shipments every single day. Now here's where you need to understand the financial physics at play. Military conflict in or around the Strait of Hormuz doesn't just affect oil prices. It sends gold and silver surging because global investors flee to the oldest safe havens humanity has ever known. War uncertainty plus energy supply disruption equals precious metals bid up overnight in ways that make normal market movements look like rounding errors. So that's freight train number 1, barreling toward us with tremendous momentum. Freight train number 2 looks completely different, but carries just as much force. Today at 10 a.m. Eastern, the Supreme Court takes the bench for its first opinion day in weeks. Among the cases they've been deliberating is the constitutional challenge to President Trump's use of the International Emergency Economic Powers Act, IEEPA, to impose sweeping tariffs without congressional approval. Here's the number that should grab your attention. Well, $133.5 billion. That's how much tariff revenue has been collected during the 100-plus days the justices have been considering this case. Treasury Secretary Bessent publicly warned that if the court strikes down these tariffs, refund claims could reach $1 trillion by June. Pop quiz: what happens to markets when $133 billion in government revenue suddenly becomes legally questionable? If you guessed volatility, you're paying attention. But the specific volatility pattern matters enormously for precious metals holders. Here's what the administration has already telegraphed, and this is crucial for understanding why any dip would likely be temporary. Officials have confirmed that if IEEPA tariffs get struck down, they'll reimpose the same tariffs within days using Section 232 of the Trade Expansion Act, a different legal authority with stronger historical precedent. Think about what that means practically. The Supreme Court could hand down a ruling that temporarily removes tariff support from silver and gold prices, industrial metals that benefit from trade barriers, because domestic production becomes more competitive. Prices might dip for a few trading sessions, while headlines scream about constitutional crises and market chaos. But underneath that noise, the structural reality hasn't changed at all. The tariffs come back under different legal authority. The military buildup continues, regardless of what 9 justices decide about trade law. And the physical shortage we're going to examine in detail hasn't magically resolved itself because of a court ruling. This is why the next 72 hours require a specific kind of attention that goes beyond watching ticker symbols. You're not just tracking two news stories. You're watching a collision between geopolitical force and constitutional law, where the timing couldn't be more compressed if someone had designed it to test precious metals investors' conviction. Consider your own situation for a moment. If you're holding physical gold or silver right now, you need to understand which scenario you're positioned for. If you're sitting in cash waiting for an entry point, you need to know whether the dip you're hoping for is a genuine buying opportunity or a trap that closes before you can act. The answer depends entirely on understanding something most financial commentary completely ignores. These events don't just add together. They interact in ways that create specific outcomes, and only one of those outcomes is genuinely bearish for metals. The deployment pattern tells us military planners aren't bluffing about Iran. The Supreme Court calendar tells us legal clarity on tariffs could arrive within hours or days, not weeks. And the numbers coming out of physical metals markets, which we're going to break down in detail, tell us that paper prices have diverged from physical reality in ways that can't persist much longer. What happens when an unstoppable force meets an immovable object? Usually, something breaks. Over the next few minutes, I'm going to show you exactly what's breaking right now in precious metals markets that almost nobody is discussing. We'll look at the actual vault withdrawals, the price divergence between Western and Eastern markets, and the mathematical reality that makes current prices unsustainable regardless of what happens in the Supreme Court or the Persian Gulf. Because here's what I've learned after years of studying these markets. The biggest moves don't come from events everyone sees coming. They come from the collision of multiple forces that mainstream analysts track separately instead of together. And right now, we're watching exactly that kind of collision unfold in real time. Now let me show you the evidence that transforms everything I just described from speculation into something far more concrete. Start with what happened this week in the Strait of Hormuz, because Western media buried the most important detail. Russia, China, and Iran launched joint naval exercises called Maritime Security Belt 2026 in the exact waters where our carrier strike groups would need to operate if military action begins. The Russian corvette Stoichi docked at Bandar Abbas, Iran's primary naval port on the Persian Gulf. Chinese vessels joined the formation, and Putin's Security Council aide Nikolai Patrushev explicitly framed these exercises as the maritime dimension of BRICS cooperation against what he called Western hegemony. Read that again and let it sink in. This is not the isolated Iran our military confronted during previous standoffs. This Iran has active military support from two nuclear powers conducting joint exercises in the precise waters where any American strike would need to project force. The strategic calculus has fundamentally shifted, and that shift has direct implications for how conflict risk gets priced into precious metals. Think about what Russian and Chinese naval presence means practically. It doesn't necessarily mean they directly engage American forces, though that risk now exists in ways it didn't before. What it definitely means is that any military operation becomes infinitely more complex, more likely to escalate, and more likely to disrupt global trade flows in ways that send capital flooding into safe haven assets. But here's where the story gets really interesting for anyone holding gold or silver. While geopolitical tensions have been building above the surface, something remarkable has been happening in the physical metals markets that most investors completely miss because they only watch spot prices on their screens. COMEX, the primary exchange, where paper gold and silver contracts trade in America, just crossed a threshold that veteran metals analysts have been warning about for years. Registered silver inventory fell below 100 million ounces. As of February 11th, the official number stood at 98.1 million ounces. Now, that number by itself might not mean much to you, so let me put it in context. On a single day recently, 3.26 million ounces moved out of the registered category. That's metal that's specifically earmarked and available for delivery against futures contracts. The same day saw another 4.7 million ounces exit the eligible category. We're talking about nearly 8 million ounces of silver leaving COMEX vaults in 24 hours. But the really stunning withdrawals happened in early January. Over just 7 trading days, 33.45 million ounces of registered silver walked out the door. That's 26% of the registered inventory gone in a single week, as traders demanded physical delivery weeks ahead of normal settlement schedules. Ask yourself a simple question. Why would sophisticated traders pay the costs and hassles of taking physical delivery early unless they were genuinely concerned about whether the metal would be there when they needed it? The answer becomes obvious when you look at what's happening on the other side of the world. After the COMEX price crashed on January 30th, something unusual appeared in Shanghai. The cash price for physical silver on the Shanghai Gold Exchange traded at a 29% premium over Western markets. That's $22.98 per ounce higher than what American traders were paying for paper contracts. Now factor in China's 13% value-added tax on silver imports. When you add the tax to the already elevated Shanghai price, the wholesale premium reached 45.8% above Western levels. That created a $34 per ounce arbitrage opportunity for anyone who could source physical silver in the West and ship it east. XTB reported that Shanghai silver contracts surpassed $125, while comparable U.S. contracts traded around $112. That's not a rounding error or a temporary blip. That's a fundamental disconnect between paper prices and physical reality that's actively draining Western vaults. Here's the mechanism you need to understand. When Shanghai pays significantly more than New York or London for the same metal, arbitrageurs step in. They buy physical silver wherever they can source it in the West, pay the shipping and insurance costs, and sell it in Shanghai for a guaranteed profit. Every ounce that makes this journey is an ounce that leaves our vaults and isn't coming back. This is happening right now, in real time, week after week. And it's not just silver. The entire precious metals complex is experiencing a physical squeeze that paper prices haven't fully reflected yet. Gold reached an all-time high of $589 in January before pulling back. Silver touched $78. But those headline prices mask what's actually happening in the physical market, where premiums over spot have expanded and delivery times have stretched in ways that suggest supply isn't keeping up with demand. The World Gold Council reported that central bank gold purchases reached record levels in 2024 and show no signs of slowing in 2025. These aren't speculative traders who will flip their positions when prices dip. They're sovereign wealth funds and national treasuries accumulating metal for strategic reserves, metal they have no intention of selling back into Western markets. Meanwhile, industrial silver demand continues climbing. Solar panel installations are growing exponentially worldwide, and each gigawatt of solar capacity requires roughly 20 tons of silver. Electric vehicle production is accelerating, and every EV uses substantially more silver than a conventional car. The Silver Institute projects structural deficits, where demand exceeds mine supply, extending as far as forecasters can model. So we have a situation where paper prices are set in Western futures markets, but physical demand is increasingly concentrated in Asia, where buyers are willing to pay substantial premiums. COMEX vaults are draining at rates that would have seemed impossible 5 years ago, and the world's largest central banks are accumulating gold without apparent regard for price. Now layer the geopolitical situation back on top of this physical market reality. If military action against Iran disrupts energy flows through the Strait of Hormuz, even temporarily, we would see the kind of safe haven bid into precious metals that overwhelms normal market dynamics. The June 2025 overnight repricing, when gold jumped more than 10% in a single session, would look like a warm-up act. But even if somehow diplomacy prevails and tensions de-escalate, which Trump's advisor puts at only 10% probability, the physical shortage doesn't magically resolve. Shanghai doesn't suddenly decide Western prices are fair. COMEX vaults don't refill themselves. The structural forces draining metal from west to east continue operating regardless of what happens with Iran. This is why understanding the interaction between these factors matters so much more than tracking either one in isolation. The mainstream financial media presents geopolitical risk and physical market dynamics as separate stories. One goes in the international news section, the other appears in commodities coverage, and never shall they meet. But for anyone actually positioned in precious metals, these forces combine and amplify each other in ways that create specific outcomes. Think about the 4 possible scenarios we're facing. War plus tariffs upheld equals the most bullish case for metals, where safe haven demand spikes while trade barriers support domestic pricing. War plus tariffs struck down creates volatility where war dominates, but expect 5 and 10% daily swings as traders process conflicting signals. Peace plus tariffs upheld means metals likely hold current levels with the structural deficit unchanged. Only peace plus tariffs struck down produces genuinely bearish conditions. And even then, it's temporary because tariffs return under Section 232, and COMEX doesn't magically refill. The administration advisor put peace probability at 10%. That means there's a 90% chance of the scenarios where conflict dynamics drive metals higher, or create the kind of volatility that rewards prepared investors. Those aren't my odds. That's the Trump administration's own assessment, reported by Axios, with carriers already in position and B-52s already deployed. Now let's look at exactly what the math tells us about where prices go from here, because the numbers reveal something that current market prices haven't yet absorbed. Let me walk you through the 4 scenarios we're actually facing, because understanding these possibilities is the difference between reacting emotionally to headlines and positioning intelligently for what comes next. Scenario 1. Military action against Iran proceeds while the Supreme Court upholds tariff authority. This is the most bullish outcome for precious metals, and it's not even close. You'd have safe haven demand spiking from geopolitical uncertainty at the same moment. Trade barriers continue supporting domestic metal prices. In this scenario, gold doesn't just hold its January high, it breaks decisively above $5,589 and enters price discovery territory where technical analysis becomes almost meaningless. Think about what happens to your portfolio in this environment. Every pension fund manager, every sovereign wealth fund, every family office around the world scrambles for the same limited pool of physical metal. Silver, with its tighter supply dynamics and industrial demand profile, could legitimately test triple digits. The $100 silver that seemed like fantasy talk a few years ago becomes the conversation we're actually having at dinner tables across America. And here's the thing most analysts miss. Once gold breaks convincingly into new all-time highs, it tends to run further and faster than anyone expects. That's not speculation, that's the historical pattern from every major gold bull market. The initial breakout is just the beginning. The real gains come in the months that follow as institutional money that was waiting on the sidelines finally capitulates and chases price. Scenario 2. Military action proceeds, but the Supreme Court strikes down IEEPA tariffs. Here's where it gets genuinely interesting for active traders. War dynamics dominate the narrative because geopolitical risk always trumps trade policy in the short term. When missiles are flying and shipping lanes are threatened, nobody cares about constitutional questions around trade authority. But you'd see real volatility. Expect 5 to 10% daily swings in silver as the market processes conflicting signals. Picture yourself watching your brokerage account during those sessions. One day, silver gaps up 8% on Iran headlines. The next, it pulls back 5% on tariff ruling fears. Then it rips higher again as conflict escalates. That kind of environment shakes out weak hands and rewards investors who understand that Section 232 tariffs return within days and the war premium isn't going anywhere until the situation fully resolves. The dip from tariff uncertainty creates a buying opportunity, but only if you have the conviction to act while others panic. Scenario 3, diplomatic breakthrough plus tariffs upheld. Maybe Iran blinks at the last moment. Maybe back-channel negotiations through Oman or Qatar produce a framework that lets both sides claim victory. Maybe the 10% probability the Trump advisor mentioned actually comes through against the odds. In this case, metals likely hold near current levels without the explosive move higher. The safe haven bid fades as traders unwind their war hedges. But here's what doesn't change. The structural deficit we examined in detail. The draining COMEX vaults don't suddenly refill. The Shanghai premium doesn't collapse. Central banks don't reverse their accumulation programs. You don't get the moonshot, but you don't give back gains either, because the physical shortage that's been building for years remains completely intact regardless of what happens diplomatically with Iran. Scenario 4, diplomatic breakthrough plus tariffs struck down. This is the only genuinely bearish combination, and even calling it bearish requires serious context. Gold might pull back toward $4,500. Silver might retrace toward $70. If you bought at recent highs and you're watching screens during that pullback, it would feel painful. No question about it. But before you let that possibility paralyze you, remember 2 crucial facts. First, the Trump advisor put diplomatic breakthrough probability at just 10%. That's the administration's own assessment, not wishful thinking from metals bulls. Second, even in this worst-case scenario, COMEX doesn't magically refill with 30 million ounces of silver. Shanghai doesn't suddenly decide Western prices are acceptable. The structural shortage persists, which means any dip becomes a buying opportunity for patient investors who understand physical market dynamics rather than just watching ticker symbols. So when you actually map probabilities to outcomes, you're looking at a 90% chance of scenarios where conflict dynamics either drive metal substantially higher or create the kind of volatility that rewards prepared positioning. Only that remaining 10% produces conditions where current prices look expensive, and even then, temporarily, because the tariffs return under different legal authority within days. Those are odds that professional traders would take every single time. Now, let me give you the specific dates that matter, because timing is everything when multiple catalysts converge in a compressed window. Today, February 20th, the Supreme Court takes the bench at 10 a.m. Eastern. This is their first opinion day in weeks, and the tariff case is among the most consequential on their docket. 9 justices will walk into that chamber this morning, and by this afternoon, we might have clarity on $133 billion in collected revenue. If they rule today, markets will react within minutes. Algorithms will parse the decision before most humans finish reading the headline. If they don't rule today, the next scheduled opinion days are Tuesday and Wednesday of next week. Each additional day without a ruling extends the uncertainty that's currently priced into markets, keeping volatility elevated. Tuesday brings President Trump's State of the Union address to a joint session of Congress. Given everything we know about military positioning and the administration's stated 90% probability of kinetic action, this speech could contain language about Iran that moves markets overnight. State of the Union addresses have historically been moments where presidents telegraph major policy shifts to the American public and the world. Watch not just what he says about Iran, but how Asian markets respond in the hours between his speech ending and our exchanges opening Wednesday morning. That overnight session could be where the real action happens. The USS Gerald R. Ford's arrival in the eastern Mediterranean is another critical marker that isn't fixed on any public calendar, but matters enormously for timing. Pentagon officials specifically identified the Ford's positioning as a key factor in timing. Our newest and most advanced aircraft carrier left Morocco and is currently steaming toward its operational position. When it arrives, the administration has the full military capability it wants in place. 2 carrier strike groups, B-52s in Qatar, the nuclear detection aircraft, everything positioned and ready. Track the Ford's location if you can find reliable reporting on it. Its arrival could precede military action by hours, not days. And then there's the March COMEX delivery period, which begins in just 5 trading days. Here's the number that should keep futures traders awake at night. There's currently over 400 million ounces of open interest in silver contracts against just 98 million ounces of registered inventory available for delivery. That's a ratio of more than 4 to 1. 4 ounces of paper claims for every single ounce of physical metal actually sitting in the vaults. Now, most of those contracts will roll forward to future months or settle in cash. That's how futures markets normally function, and it's how they've functioned for decades without crisis. But we've already seen unprecedented physical delivery demands in January, when 26% of registered inventory walked out the door in a single week. Sophisticated traders demanded their metal early, accepting the costs and hassles of physical delivery rather than trusting that the metal would be there later. If even a modest fraction of March contract holders follow that same playbook and demand physical delivery, COMEX faces a genuine crisis of confidence in its ability to function as a reliable price discovery mechanism for precious metals. Think about what that means practically for the prices you see on your screen. COMEX silver prices are supposed to reflect the real-world value of physical silver that you could actually buy and hold in your hand. But when Shanghai pays $125 while COMEX says $78, and when delivery demands are draining vaults faster than they can possibly be replenished, the paper price loses its connection to physical reality. At some point, that gap has to close. Either paper prices rise dramatically to meet physical reality, or physical metal simply stops flowing to those who offer only paper prices in exchange. We may be approaching that inflection point faster than most market participants realize. Let me put all of this together now, because the synthesis matters far more than any individual data point we've examined. Gold is trading around $5,000. Silver is around $78. But Shanghai is paying $125 for silver, a 60% premium that's actively draining Western vaults through arbitrage flows that happen every single week. COMEX is hemorrhaging over 20 million ounces of silver per month to physical delivery demands and vault transfers. 20% of all global oil flows through a narrow strait, where Russia, China, and Iran are conducting joint military exercises, while American B-52 nuclear-capable bombers sit loaded and ready just 400 miles away in Qatar. Ask yourself honestly, have current prices perfectly anticipated everything that could happen over the next 72 hours to 2 weeks? Has the market correctly priced Supreme Court uncertainty, military action probability, COMEX delivery dynamics, and the Shanghai premium all at once? Based on everything I've shown you today, I don't believe markets have priced this correctly. The paper market and the physical market have diverged too far for too long. The geopolitical risks are too concentrated in too short a time frame, and the structural shortage in silver is too severe to resolve through normal market mechanisms operating at normal speeds. What happened in June 2025 was a preview, not an anomaly. Gold moved more than 10% overnight when investors suddenly reprocessed risk that had been building beneath the surface for months. One day prices looked stable, the next morning everything had changed. The conditions today are more acute than they were then. More military assets deployed, more physical metal leaving Western vaults, wider divergence between Eastern and Western prices. Here's what I want you to take away from everything we've discussed today. We're not predicting disaster or trying to frighten you into action. We're recognizing that multiple powerful forces have converged in ways that create asymmetric outcomes, situations where the potential upside substantially exceeds the potential downside across most probable scenarios. Understanding this clearly isn't about fear. It's about seeing what's actually happening beneath the headlines, so you can make informed decisions for yourself and your family. The Supreme Court ruling could come in hours. Military action could come in days. The March COMEX delivery period begins in less than a week, and through all of it, physical metal continues flowing from Western vaults to Eastern buyers, while paper prices pretend nothing unusual is happening. Something has to give. When it does, it won't announce itself with a polite warning or give you time to react. It will happen overnight, just like June, and by the time most investors understand what's occurring, the repricing will already be behind them. Now you know what to watch for. Now you understand the forces at play and how they interact. What you do with this information is entirely up to you.